everyone. Thanks a lot for those of you who are already here. We'll wait a couple more minutes as others slowly trickle in. So if you are here, um, grab that cup of coffee, run to the bathroom, whatever you need to do, and we'll get started right around 12:02 Eastern. All right, and thank you again, everyone, for joining us. We're going to go ahead and get started now. So, today's webinar is going to be Private Real Estate Debt and the Self-Directed IRA, What the Headlines Are Getting Wrong. Whitney Elkins-Hutten will be presenting. Um, Before we get started, we're going to have our obligatory disclosure. So, this is for present educational purposes only. Plan is not a tax advisor or an investment advisor, so please do your own due diligence and seek out the advice from the appropriate professionals. Also, a housekeeping item is that we'll have the chat turned off, but we'll have the Q&A function turned on, so please ask your questions throughout the presentation and we'll find an opportunity to cover those. And then the last item is that if you have any questions about self-direction, account types, what you can do, what you can't do, anything like that, or if something gets missed during the presentation you want to ask later, please feel free to reach out to me directly. I'm Matt Moore. I do business development here at Plan. And you can also schedule a call if that's easier too. So email, call, text, or schedule a call. So that is it for me. Whitney, I'm going to turn off my screen and turn things over to you.
Awesome. Thank you so much, Matt. Well, yes, thank you everybody for joining today. Again, my name is Whitney Elkins-Hutten. I am the Director of Investor Education here at PassiveInvesting.com. We are a private equity firm based out of the Carolinas. And what I do here is, I really help educate people to take their active income and savings and turn it into passive income and long-term wealth. So if you're here today watching today's webinar, you're probably, in one of two camps. One, like you're just like, I've tried passive investing before, maybe even in private credit, and I just kind of get comfortable making the investment. Or maybe you have invested in these type of de deals before and you want to sharpen your skills. If that's you, welcome, you're in the right place. Again, at passiveinvesting.com, we have a first position lien, no fund level levered debt fund. We've lent out actually over 600 million across 2,650 plus loans. extremely low default ratio, as well as zero capital deficiency. So we're super proud of this fund that we run here. More about me personally. This is the whole reason why I invest passively in, private credit, private real estate debt funds. More importantly, just passive investments is so I can spend time in the mountains with my crazy crew. We love camping, we love traveling, we love spending time together with our family and friends. And so this is my husband and my daughter in the Cascades last summer after they jumped in this high altitude alpine lake. I was the videographer, I was not the participant. But anyways, I just love doing this type of things together. And it's what my real estate portfolio is, and more importantly, my passive investments has allowed me to do this. Personally, I'm a partner in over 800 million of real estate, largely residential units, a little bit of express car washes and self-storage, and I've done a lot of fix and flipping. And so when I talk to you today about private credit and private real estate debt funds and all the questions that we'll tackle there, just know that I'm coming from the point where I've done pretty much all the different functions you can in real estate on some level. I've written about it in my book, Money for Tomorrow, How to Build and Protect Generational Wealth. And if you want to check out some additional educational material from me, you can check out not only passiveinvesting.com, but Passive Investing Made Simple. That's my YouTube show. Now, everything that I do is, to show the investor how to get 100% control and choice on how they spend their time. It's what I've been able to do. And I still work, but I love doing, hopefully the passion shows through in my voice. Like I love doing this. I love educating the investor. So if you want to connect with me, instead of making you wait until the end for my contact information, here you can join our passive investing club. Just go to passiveinvestingwithwhitney.com. There, you and I can hop on a one-on-one call, talk about vetted opportunities, and connect with more resources. I always put this disclaimer, any video you watch, whether it's on YouTube, TikTok, Instagram, but even with other financial companies, thank you so much to Camel Plan today for hosting us. It's for educational purposes. So it's not tax advice, legal advice, or financial advice. So make sure you consult with your team before making any decisions. Now, we are coming together today, as Matt said, to talk about, private credit, and the self-directed IRA. So what are the headlines getting? Mostly what are they getting wrong? Because there are very little things that they're getting right. The headline news is all about selling fear, I think. I think if they like sold like the people click based on fear. So I want to tease out what why that fear, why headlines actually put that fear out there in the environment, but more importantly, empower you as the limited partner to understand the difference between private credit, that space, and private real estate debt. Because even though they're kind of conflated, they're two distinct entities, and we're going to tease out the structure of these investments. And then we're going to take the journey even further to like, how does it pair with the self-directed IRA? And what do you, as the limited partner, need to know about putting a private credit or a private debt investment into your IRA, and why that might be a good thing as opposed to putting an equity investment in your IRA. And I'm going to show you the math. Like, we're not going to talk hypothetical. I'm going to show you some math today too. Um, but more importantly, you've spent a lot of time and energy building your income, your investments, your retirement account. And I think a lot of limited partners, I know myself, right now, we're looking at the headlines. I mean, and it's scary. We're in the middle of inflation, a physical war going on. Like, unfortunately, it's not on our shores. We've got tariffs in the background. We've got all this uncertainty that's leading to as I call it the AI on, AI off stock market. Like one week it's going up, the next week it's coming down, 7 to 10%. Which by the way, if it's on sale, maybe a good time to pick up some stocks. But regardless, public equities, that stock market, it feels stretched, right? It feels like we keep bumping up against the ceiling. Are we at the top and we're waiting for a tumble? Private credit, a lot of people would be like, okay, if I'm not going to do public equities, then what else am I going to do? Like, I'm going to go into private investment? Is this a good time to get back into multifamily or self-storage or industrial? You're like, are we still catching a falling knife in those areas? What about private credit and private real estate debt? I hear a lot of grumblings going on with BlackRock and Blue Owl marking down their assets in their portfolio. And what this leads a lot of limited partner investors doing is just sitting on their capital. It's sitting idle. Okay. But the problem is if you have capital sitting idle in a retirement account, that is an amazing compound engine. And I'm going to show you how that engine actually works. And you're not taking full advantage of that compounding engine. But I want you to know you're not alone. Okay. I'm feeling it. I mean, pretty much any investor in the room is feeling it. There might be that one person that's like, heck, I don't pay attention to any of this. I'm totally fine. But all of us are feeling this in the market. So, what are we going to do with it? Um, Well, this is where I really lean on. If you've ever read the book by Ray Dalio, Principles, one of the things when he created the all-weather portfolio is that he actually looked at his portfolio, only 50 to 55% of his portfolio performing at any one point in time, which meant that as the market cycled, as we go through recovery into hypergrowth, into hypersupply, back down into a recessionary environment, the the assets in his portfolio were rotating on what was performing. And one of the core things in his portfolio are like things like commodities or things that in credit. And but you and I both know we've already touched on this. Like if we say private credit right now, a lot of, if we read that, go on Google or go on to ChatGPT and look at private credit, you're going to get a lot of negativity in this area. And that's rightfully so. When we look up can I invest in corporate credit or private credit? Okay, maybe these things are backed by bonds or direct investment. Um, there's a lot of issues with them right now, and I'm going to show you the structural issues with them. But those private credit investments, they're rate sensitive. If anybody's paying attention to the 10-year treasury right now, it's ping-ponging around. And it's pretty high right now, but we don't know where it's going to go. I mean, as soon as the Fed starts changing their mind on interest rates, that 10-year treasury might start coming down. Now, I offer as a counterbalance the first position lien real estate debt fund. Now, that is a private credit investment. It does fit under the private credit umbrella, but it's collateralized. Okay. It's not a leveraged corporate loan. We're actually able to work individually with borrowers that have an equity stake in the investment as opposed to an asset that has kind of a questionable valuation. We have very short cycle loans in a portfolio like this, um, which means the portfolio can reprice itself every 6 to 9 months, whereas you have a private credit investment, those loans might be 24, 36, 48 months. Um, so this type of real estate debt fund, and we're going to go into details, tends to be more insulated from the stress in the corporate market than corporate private credit type investments. So now that we understand how these two kind of break apart, right? If we say private credit is the umbrella, there's the corporate private credit and then the real estate debt private credit. Um, you know, SDRA investors still make two mistakes, even though they do understand the difference between those two types of debt. And the real mistake that they make is evaluating the asset class by the label and not looking at the structure of the investment. And that's where I want to go to next. Okay. And the reason why we have to understand the structure of the private credit investment is because remember, your self-directed IRA is a compounding engine. And you get tax-free compounding. Any capital you leave idle in your self-directed IRA has a permanent loss, and that would go for anybody, even if the capital were sitting in their bank. It's an opportunity cost by not having it invested. But a lot of self-directed IRA investors think just moving their money into a self-directed IRA itself is an investment. No, the self-directed IRA is just a wrapper. It's a strategy. We still have to correctly allocate those funds. All right. So how does private real estate debt actually work? right? That's a lot of times the question that I start off with. It's just starting back to basics. Okay, Winnie, I understand that there's a difference between these two worlds of corporate credit and real estate debt, but how does this private real estate debt thing actually work? Well, let's first define private real estate debt, like a debt fund, is simply a collection of loans, meaning that fund is the bank to a borrower. Much like if you own your primary residence, your bank that you got your mortgage from is the bank to you as the borrower. Now, as opposed to just making one loan like the bank did, that fund actually makes multiple loans. In our fund, we make 400 to 450 loans at any point in time. But how do they actually make money? That's kind of the next thing that needs to click in people's heads. Okay, so the fund actually will raise capital to lend. Okay, then they actually they loan money out. This isn't actually, it should be a circle, but anyway, fund lends money. The borrower pays interest on that loan. Eventually, the loan is repaid, and when the loan's repaid, it doesn't necessarily go directly back to the person who lent the money. Okay, it goes back to the fund, and then the fund can recycle the capital and loan it out again. Now, for you as a self-directed IRA investor, this is amazing. You don't have individual notes that you're making out of your account and then coming back, and then you're paying your custodian, sorry, the fee to make a new loan again. You just made one investment into a fund, and then the fund is recycling your capital into more and more and more notes. That money continues to go out, and your investment babies continue to make babies. Um, so that's the basis of like what the two instruments are. How does the real estate debt fund make money? Now, we mentioned that you have to understand the structure of a fund, okay? And that is where the real risk lies when you invest in real estate debt funds, okay? In your taxable accounts or with your IRA accounts. Now, a lot of investors I speak to, they'll be like, I don't need the money in my IRA account right now. So I'm going to take that money, I'm going to invest it in the highest yield I can to make the most amount of money I can. So they get attached to the yield. Now, the thing is, when I, help people understand how to invest in real estate debt, it risk just shows up in a very different place when compared to like a multifamily or self-storage or an industrial equity deal. Okay, there's still risk. It just shows up differently. And these are the places that the risk actually shows up. The first, and we're going to dive deep into each one of these areas, but just kind of really cursorily going over it. The first place that risk shows up is what position in that debt fund you just invested in. Okay, if they're going out and making a loan, what position is that loan? Are they in first position, second position? Okay, that is, I love real estate debt funds where they're all in first position. Okay, that means that the borrower defaults on the loan, the fund gets to take the property back, either through like a deed in lieu or a foreclosure process. And we'll go into more detail on that. But here's the kicker. Just because it's a first position lien fund, we want to make sure there's zero fund leverage, meaning the operator didn't raise money from you to take it to the bank to go get more money in order to lend. Now, why? Why do you care? Those type of funds might have a higher rate of return. Here's the kicker. If the operator took your money to go to the bank to get more money, are you in first position anymore? You're behind a bank. All the loans might be in first position, but you're now in an equity position in the fund, meaning you're behind an obligation to the bank. All right, we're going to dive into that and understand the mechanics of how that can really impact the fund. The other thing when we talk about, real estate debt funds, and this goes for any sort of private credit, what position of the private credit are you in? Now, what is the duration of the loan? Okay. We want to be in those shorter duration loans. Why? because the fund can reprice itself to market much faster. Okay. It's not, the capital isn't tied to a single borrower for years or to a single asset for years. Okay. There's plenty of opportunity for recycle and repricing. All right. This is where you see, BlackRock and Blue Owl kind of get themselves into trouble, right? They made an asset that they didn't have a clear valuation on, and it was an asset that they picked up in 2021 or 2022 that the asset has a much different valuation 3 or 4 years later. They couldn't reprice that loan, for 3 or 4 years. So essentially what you're seeing is these 20 a different vintage of asset being written off. Okay. That typically is a yes, you can make more money that way, but for you as an investor, especially if you're investing in retirement funds, I would tend to opt for the shorter duration. Number three, another risk when you invest in a real estate debt fund is you want to understand how much equity the borrower is bringing to the deal. Okay. So, in a lot of real estate debt funds are, and especially in ours, when we underwrite the borrower, we make sure that they're bringing 30 to 40% of the equity of that deal to the table before the loan even closes. Okay. That way, if there's a loss or if they can't execute the business plan, the borrower is in the first position, that risk position, not the money in the fund. Okay. But we're going to see how first position lien and borrower equity, how those two collide later on if we're not watching carefully. Risk number four, making sure that the assets in the fund are actually valuated by third-party cash valuations. So this is where you start learning about terms like appraisals, broker's price opinion, broker's opinion of value. We want to make sure that those any asset that goes into the fund has a clear valuation. Okay. So point risk number two and four is the reason why we're seeing a lot of these write-offs in the private credit space because they were long loans without a clear evaluation of the asset. So here's kind of your five-factor audit. We're going to go through each one of these in a little bit deeper detail, but if you want to take a screenshot, like when you are looking at a private real estate debt fund, these are the first five things that you're going to tackle. Okay. And now on the previous page, we pulled two things together when we talked about our fund level leverage in conjunction with the lien position. But this isn't a total due diligence, but this is your first screen of maybe a deal you're looking at, or if you want to go into a deal, this is your first screen. Okay. So let's go through each one of these one by one. Valuation method. Okay. The question here is who conducts the valuation and what methodology do they use and how often? Okay. We want to make sure that things are third party validated. There's independent appraisers or a named real estate firm or someone like that conducting the valuation. Okay. Most importantly, we want to make sure the fund manager is removed from the equation. Why? Because if the fund manager is involved in the valuation, they might be incentivized to overvalue an asset and lend out too much money on a deal. It happens all the time. There are some very high profile real estate debt funds out there right now that actually do self-reported valuations. Okay. Here's the thing. When you do an independent appraisal or broker's price opinion, that document also comes with a methodology. The methodology is documented and it's repeatable. Okay. So it's something that you as an investor can verify. Okay. We're not just asking you to blatantly trust, you can verify the process. Whereas if we go with something like self-reported valuation, the fund manager controls the numbers. Okay. There is a conflict of interest. I'm not saying that this is a very legitimate way of valuing property, but there is a conflict of interest because the fund manager wants to lend out the most money so they can get the most interest and split that with their limited partner. So the conflict is are they actually lending out the right valuation or potentially overvaluing the properties? Okay. And the last piece, there's no real independent check on the asset quality from a third party. Factor number two, we've talked the loan duration, the recycle rate. We've talked about this, but just to recap, short cycle funds tend to have a lower risk because that fund can continuously re-underwrite risk in the market at the current market conditions. When they also the concentration risk stays contained to the current market cycle. All right, what do I mean by that last statement? It means um, if a fund, say, does primarily multifamily real estate, right, bridge debt lending, and they started that fund was really heavy in 2021 and 2022 assets, they can't move the fund. Those loans are like, 18 months to 36 months. They can't right the ship very quickly. All right. It's going to take them 3 or 4 years to right that ship. So they're going to stay exposed to that concentration risk for a lot longer. All right. So long duration loans, they're higher risk, okay, because you're locked into a single borrower and a single asset for a longer period of time. But more importantly, you get that concentration risk and the valuation risk. What happens to that asset? Not only the concentration risk, but does the valuation of that asset come down? So another question to ask here is what's the average of the operator? What's the average loan term and how many times does the capital recycle annually? Factor number three, borrower equity at origination. Okay, I already mentioned that I love real estate debt funds that where the borrower is automatically, on the hook for 30 to 40% of the equity at origination. Okay, now that's not them putting 30 to 40% of the down payment. Okay, that means over the overall completion of the project, say they can't sell or refinance, 30 to 40% of that equity cushion, that's theirs to either make money or it's the cushion before the loan. So the borrower has significant capital at risk because we're making sure all those numbers are actually underwritten by third-party valuations before closure. We have a pretty clear understanding what that is. Now, two things can happen here. Borrower equity at origination. I see debt funds where the borrower equity at origination might be as small as like 10%. All right, I mean, I was given a presentation the other day, and an investor asked me a question in the chat box, and they were like, how far have you seen valuations go down over time? And I actually done some research prior, and I have never seen a housing market collapse 30 or 40% in a single 6 month period or a 9 month period. Not even really a 12-month period, but I've seen it go down 10%, 15% in a 1 year period. Okay, so um, that gives if we have thin equity at origination, that operator might be playing a numbers game, not so much like protecting, trying to do their best to keep zero defaults. Okay. Now this, the question to ask, what is the fund's maximum loan to value at origination and how is it calculated? You want to understand that actual number in the calculation. Um, this equation actually gets worse with fund level leverage, and we'll talk about more of that in a minute. All right, factor number four. How does a real estate debt fund actually mitigate the downside and recover the asset should the borrower not be able to perform? Okay, it's not a matter of if a loan will go sideways or south. It's a matter of when, right? It's if any of you have owned your own single family rental real estate or any real estate at all, it's not a matter if a tenant's going to turn over or if you're going to have an eviction. It's a matter of when it's going to happen. So you need to be prepared. Now, a lot of real estate debt funds, they might be playing a numbers game. So meaning they originate the loan and then they don't really the loan interest and payment, principal payment aren't due, say, for 6 months or 9 months. Um, what happens? How does that our operator actually know what's going on with the borrower in that time period? That's a numbers game. What I like to see in real estate debt funds and what protects you as a limited partner is if there's a clear mechanism to track that borrower on a monthly basis. And so, what I actually like seeing are real estate debt funds where the borrower is immediately, like if they miss any payment, there is a mechanism, there's a trigger that triggers a process for the recovery, meaning that the operator is immediately filing that deed in lieu, meaning that they can take the property back without going through a foreclosure process, or they actually can file for foreclosure. They're actually filing the foreclosure right then. Another part of this trigger process that I like seeing is that the operator actually has the borrower list the property for sale. Okay. Now, that sounds like it might kind of like cap the borrower. Well, if the borrower knows those things are going to happen up front should they miss a payment, you tend to kind of attract your better borrowers, right? And kind of like, get the cream of the crop. But also remember there's a cure process in here, all right? If all of a sudden like the borrower is 5 days late and they make everything whole, then there's an opportunity to cure. All right. But all of this to say is that what the ultimate result is to protect the investor outcome. Okay. We want to make sure that capital is preserved and there's an actual documented result, and we want that committed to upfront. So when you're talking to an operator, you want to look out for a defined recovery process. You want to understand what they do for defaults, okay? Because remember, it's not a matter of if a borrower is going to default, it's a matter of when, okay? And what is the has the outcome been for the investor? Now, just because a fund has defaults, we do want to see low defaults, right? Like under 3%, it would be fantastic. Industry standards about 5 to 10% default. Um, what you want to see is very low deficiencies or no deficiencies. What is the difference between default and deficiency is default just means the borrower stopped paying. Deficiency means that the property couldn't be repositioned without losing money to the fund. Okay, so we need to look at those two numbers together. Now, factor number five is fund level leverage. All right, this is the one that most investors don't ask about. One, because I think that they don't really understand what to ask. But fund level leverage does two things. One, we're going to tie it back to the equity in the investment. Okay. Two, we're going to tie it to how it can actually be a little ticking time bomb in a self-directed IRA. So first, if you have fund level leverage, the this tends to amplify the fund returns. That sounds fantastic, right? Okay, if I can get an extra 100 basis points, amazing. But remember, that moves you out of, say the loans were first position, that moves you into an equity position because now you're behind the bank. Two, it actually essentially cuts that equity position that you had in those loans by whatever percentage of lending is out on the fund. So it could be like 15%, 20%. I see funds up to 50%. So you thought you had a 30% equity cushion, now you have 15. Okay. So yes, it can amplify the upside, but it can also amplify the downside too. Now, here's the other thing that a lot of investors don't think about when it comes to fund level leverage is that in an IRA, IRAs are subject to UDFI, unrelated debt financing income, and then unrelated business income tax. Now, if you don't know what those things are, I'm not a CPA. Kama Plan's not a CPA either. Make sure to talk to your CPA. I'm not saying every debt fund that uses leverage triggers UBIT, but you want to know that ahead of time before you invest. Okay, so if it triggers that unrelated business income tax, that tax drag you were trying to avoid by investing in your IRA now shows its ugly head. So the question is, does the fund use any form of fund level leverage, and how does that interact with the IRA account type? So those, the first part of that question is for the operator. The second part of that question is going to be for your CPA. All right. So we've covered what is real estate debt. Okay. How does that differ from private credit? We've covered the five factors that I look at when it comes to understanding real estate debt. Now I want to start putting this debt in the SDI IRA wrapper and showing you how it can perform. Okay. And this is not financial advice. But a lot of people kind of push back on me when I say, hey, like a real estate debt fund is an amazing investment for your self-directed IRA. Um, you can just, you have this amazing compounding engine. You can put it in there. You can just let it compound and grow. Okay. So you essentially get an equity-like return. And then, at least with our self-directed, or excuse me, our real estate debt fund, when you're ready to take cash flow, say like you're at 59 and a half, you can just flip the switch and now it's not compounding anymore. You're not got this compounding fund in a compounding wrapper. You can flip it and start taking cash flow. Amazing. But I always get the question, but Whitney, can't I make more money if I put, say, a multifamily or a self-storage investment in my IRA? Potentially, yes, but I'm going to show you how you have to perform, right? Like how perfectly you have to execute and what the alternatives might look like. Now, here's the thing. If you put an equity deal in a self-directed IRA, your capital is locked for 3, 7, 3 to 10 years, or at least until the exit of the property. Those distributions you can't use, okay? And there's, a lot of time pretty, you might not get consistent cash. The operator might have underwritten a 3-year exit and then it extends to 6 years. Um, you're essentially waiting. It's not true compounding, it's growth. You're waiting for that on the operator's timeline. Okay. So then you have to exit and redeploy. So you have to make sure that you don't have that timeline drag in there. Whereas a debt fund and a self-directed IRA, you've got capital recycling continuously. It becomes very predictable on the income distribution or compounding, and it all happens without a pause. So you're not really waiting on anybody's exit. Okay, so that drag alone can work to your advantage. Now, this is where a lot of people are like, Whitney, okay, so if I have $100,000, like, really, like, can I make that much money? So $100,000, you get a 17% compounded return after 10 years. Okay. But $500,000, say at 9%, that's 1.225 million. Okay, in 10 years. 500,000, that's more than double. Okay, so yeah, you can take a asset that in itself can compound, put it in an amazing compound engine like your self-directed IRA, and create some real wealth in a short period of time. All right, so let's start looking at some comparisons. So here's a comparison of taking a $500,000 investment in a self-directed IRA, or sorry, $500,000 real estate debt fund investment that kicks off 9% annualized return. We're going to allow it to compound in our compounded engine, the self-directed IRA. So we're going to have that 1.225 million upon exit. Now, if I took the same $500,000 and put it perfectly into 5 real estate deals, real estate syndications, and they just got a 14 or 15% IRR and 4% cash flow annually, I would have like a significant amount of more money. This is where I generally lose people. They're like, well, heck, Whitney, why wouldn't I do the equity? We forgot something here. Remember earlier when I said you put an equity investment inside a self-directed IRA, you get what? You get taxes. So at best, we're not in that 2.6 million. We're going to be closer down to 1.6 million. We've already chopped that down. Okay. And this, of course, we've got cost segregation and bonus depreciation. They're going to do a lot of sheltering here for us, but we're going to have a tax impact. But again, a lot of people will be like, well, Whitney, this is still great, right? I got 5, equity deals the first year, they exit. I have a 24-hour lag. I'm in my next 5, and then I exit. I'm still making $400,000 more. You and I both know that's not how real estate works. Real estate timelines change, right? So this is what happens if just one deal extends its timeline by 2 years. Everything returns are delivered, but we just extended one deal by 2 years. Okay. So when people think they put equity into a self-directed IRA and to compound, it isn't true compounding, it's growth. So what happened in this 2 years? We missed out on capturing that growth and being able to redeploy it. Okay. However, we had that $500,000 in a real estate debt fund. That is true compounding. You're buying additional shares into the real estate debt fund. Your investment babies are constantly going out and making more babies month over month over month over month. That is compounding. That is what Albert Einstein was talking about. All right. So this takes into account UBIT, right? Everybody's tax situation is different. The only variable we changed here is that one deal extended by 2 years. Okay. Everything's same. These equity deals are making money. They're performing. But what's happened in the last 5 years? Most of us have had a deal that's gone sideways or south, lost money. This is just one deal exits neutrally. You didn't lose, you just didn't make any money. We're still, the real estate debt fund is still beating the pants off of it, okay, by $200,000. Okay. And again, we've got that true compounded growth. All right. So again, I'm not a financial advisor. I encourage you to run these numbers for yourself, but I just wanted to point this out when people are looking what to put into the self-directed IRA. Don't poo-poo the real estate debt fund, especially if you can get into a real estate debt fund that offers compounding and you can put it into your compounding engine, your self-directed IRA. Okay, so I just wanted, we do have a self-directed, or excuse me, our real estate debt fund. It's built for you. It's built for your self-directed IRA. It offers a first lien position on all loans, third-party evaluations, so we don't do any self-reported asset valuations, short just cycle origination, meaning the loans are 6 to 12 months. We don't use any fund leverage. So you actually, that borrow equity that they bring in at 30 to 40% is true. So there's a true cushion there. We've got an amazing downside process, very low, right around a 2% deficiency, or excuse me, default rate and zero capital deficiencies. Now, the point of this presentation isn't to sell you on our real estate debt fund, but more importantly, to show you the power of this type of asset in your self-directed IRA. So if you want to learn more, I want you to reach out to me. Okay, because this type of tool, this type of real estate debt fund, especially the way we built it, is built for investors who are still concerned about equity evaluations. Maybe they're not ready to scale a portfolio of equity deals in their self-directed IRA. Maybe they value that consistent growth and income, that in being able to like switch that investment to income in the retirement years. If that's you, I want you to reach out to me, okay? We're going to run that 5 point fund factor audit on your current investments, what you got going currently. We can show you how it applies to our particular real estate debt fund. You can ask us any questions, especially the questions that your CPA has for us. And then we just have a very structural conversation on how this fits into your portfolio. So if that's you, feel free to reach out to me at passiveinvestingwithwhitney.com and we can hop on that one-on-one call and take it from there. What questions do we have? I know I covered a lot.
One question that came in was I've seen funds freeze withdrawals of capital or meter them over a period of time. Does your fund have a minimum investment duration or restrict withdrawals?
So any investment carries risk. I'm just going to say that. So, in your PPM for any debt fund, there's going to be some sort of gating procedure. Where we tend to see gating is on those funds that are levered or there's no long loans or no clear evaluation of the loans. Those are the three big things that are going to trigger gating. Now, why do I say that? Okay, because we are a balance sheet lender on our particular fund. So if let's just say we can't make another loan at all, like for like 2 years, right? And so we just wait for our loans to unwind, and then we pay our investors off. So that gating would be extremely short, and we have loans cycling out every single month. So maybe and what we call this is a run on the bank situation. You know, probably our max loan is 12 months, so we would have everybody paid off in 12 months, unless there was a catastrophic collapse and all of our borrowers stopped paying, which is a risk of any fund. Um, that's where being with a balance sheet lender is super critical as opposed to a lending company that sells off their loans or uses that fund level leverage. And we didn't even talk about what happens whenever a loan company sells off their loans. So that's a whole other exposure risk. Um, so, anyways, that I just wanted to make sure that we're not sugarcoating what should happen. It's going to be in your docs and any investment that you look at. But that's the difference. Like if you're with I want us to make one other clear point because I've been in a debt fund that did gate, but it was on a business. Okay. So again, no clear valuation, and those loans were longer term. I've seen debt funds that have collapsed recently. There's one out of Houston that recently collapsed. I've been talking to a ton of investors out of that fund. They're a little shell-shocked. How could I have seen this earlier? Well, it turns out that was a Ponzi scheme. That was fraud, right? Um, that's where first of all, looking under the hood immediately, like making sure the fund's actually making loans, but more importantly, making sure the fund is third party audited financials, that you've got a different accounting firm looking to make sure all the loans and how did they exit, what's the interest rate, what are the balance of the books, how did the deficiencies get handled, as opposed to just somebody said, hey, yo, trust me, right? Um, that I've seen that fund collapse. Another fund was an ATM fund that collapsed recently, and a lot of investors got stung in that. Okay. What happened there? Okay. We have that one, if there were third-party financials, they probably would have caught that one way earlier in the fund process. That person was running a Ponzi scheme for 5, 7 years. Um, again, there's mechanisms to catch these things early, but let's say that the person's not fraudulent. They're not running a Ponzi scheme. There are third-party financials. The three things that are going to trigger that gating are going to be what kind of loan are they making? What's the duration of the loan? And are they using fund level leverage?
Very good. Um, does your fund have a minimum investment duration?
As far as like a lockup, so some funds have lockup periods. We are actually getting rid of our lockup periods. So if somebody looks at our PPM today, they're going to see lockup periods for investments over $500,000. The longest lockup, and that's for $1 million and over right now, is 12 months.
Hmm.
But anything under $500,000, there is no lockup. So
Wow.
your funds can be placed, and then you can be like, oh, Whitney, sorry. I actually need that money back, or I need part of that money back. And then there's a redemption window. Our PPM allows 90 days. Remember, we're a balance sheet lender. We don't have a bank line of credit because we want all of our investors in that first lien position. Okay. We want them invested in PIC fund. PIC fund is the lender on the loan. There is no bank lending involved. Um, uh, we often, for investments under 500,000, are getting our investors' money back to them in about like 10 to 14 days. So,
Amazing.
but going forward, there will be no lockups.
Can you talk a little bit about the importance of servicing for your loans and
Mhm.
like how that, really how that should be a consideration for an investor who's doing diligence on a manager?
Yeah. So, I mean, servicing is kind of like a challenging thing to solve, and it kind of goes state by state. Some states you can self-service, the lender can actually like in-house service the loan. In other states, they have to go with a third-party servicer. The key point is, or what I see some other debt funds, they actually stand up a servicing arm. We actually partner with three or four trusted servicers in each of these states, but we have a dedicated team over the servicer. So even though that we place the loans with the servicer and the servicer is servicing the loans, it's kind of like having an asset manager over a multifamily deal or a self-storage deal. You always got that extra set of eyes watching the servicer. Now, somebody might go, but that introduced a layer of like fees. And we don't charge any fees to our debt fund investors.
Wow.
Yeah. Yes. They invest in the debt fund. They get their return first because they're in first position. And then we pay the fees, all the fees, okay, and income to any expenses or fees get paid after that. And then whatever's left over is the profit to the fund. Okay, so somebody investing in our debt fund should just be like, yay, thank you. They're actually taking that out of their profit in order to manage the loan more efficiently.
Mm, hmm,
I have
hmm.
seen funds where they've actually lost because I've seen one fund, they placed the loans with the servicer and the servicer sold off the loans.
Oh,
What? So, and that usually, yeah, that one's in a court case right now, in multiple states because the fund operated in multiple states. So, um, the fund, it looks like the fund's going to prevail, but at what cost to the limited partner investor? I don't know. The simple solve, and the operators admitted it. He was like, I shouldn't have trusted the servicer. I should have had somebody watching the servicer the whole time.
that is a terrible story. I'm not familiar with that. Um, I mean, I think that just goes to show the importance of, sure, getting a third party servicer is very, very powerful, but you
Mhm.
still, as the fund, need to not just hand complete control of the assets over to that servicer, but actually kind of service the servicer, so to speak. Make sure that they're doing
Yeah.
what they should be doing.
Yeah, it's kind of like if you own your own single family rentals or small multifamily building and you have a property manager, hopefully, right?
Yep.
Like, hopefully you're not self-managing, but you still need to manage the manager,
Right.
right?
I was actually talking to a guy yesterday, and he's an LP in a lot of deals, and we were talking specifically about uh, the world of lending and kind of how things were in the pandemic specifically, and how that was a tough time. And he said, and this is another servicing question. He kind of said, like, when do you give the borrower some leeway versus when do you, in his words, go break their knees? And you kind of spoke to this. I think it was on Factor 4 a little bit. Can you talk about like what you see as being just kind of respond to that kind of question, that thought, like when do you step in versus when do you say, hey, there needs to be a forbearance or something like that?
Yeah, so what I'll show you how we've put it in place with our portfolio. Um, at the closing table, our borrower, and they know this ahead of time, so it's not a surprise to them. They're signing a deed in lieu, especially if they're in a state that's a non-judicial foreclosure state. They sign a deed in lieu. So we don't even have to go for foreclosure to take the property back. If they are in a foreclosure state, they're signing a deed in lieu and a notice of foreclosure, meaning telling them you miss payment on day 31, day 32, we're filing for foreclosure. Now that seems really aggressive, but again, what you're trying to do is it's a weed out course. Like you take chemistry in college, it's a weed out course. Not everybody wants to take chemistry, right? But you're gonna get a lot of people out of the sciences that probably, might not, deserve or want to be there.
Yep.
Anyway, weed out course is what we're going for here. We also are notifying them that on day 32, if you miss a payment, you are have to list the property for sale. That goes for non-judicial or judicial states, period. Um, Now, at the same time, if they haven't taken their first construction draw, say by day 25, 30, that is us. That's us doing great customer service for the borrower and calling them and going, "What's going on? Hey, are you doing all right?" We're checking in with them to get a gauge of what's happening, right? So when we get to 30, 31, day 30, 31, we're left wondering, why did they skip? Okay. So what happens when we see this borrower not take a construction draw? Well,
And I'm gonna pause you for a second. I
yeah.
used to work for a lender, so I know exactly what you're talking about. But just for the benefit of people who may not be as familiar with this, can you just explain really quickly what you mean by construction draw, what you're referring to, kind of in the
Ah,
context of the project?
yeah, totally. Okay, so remember, a lot of these properties are loans. They're fix and flip loans, meaning they on single family rentals, multifamily buildings, small like 2 to 4 units, we have like 5% of the portfolio that is manufactured, stick-built manufactured homes and stuff like that. Okay. So they're buying a property, say like a 1960 property that grandma just moved out of, and it still has like, brass finishes, flowered wallpaper, and like the roof hasn't been replaced in 40 years, right? So, but it's in a solid neighborhood. So they are buying the property below value. They are saying they're putting together a construction budget and they're telling us it's going to take 30 or $40,000 to renovate this property. Okay. The roof, the foundation, the mechanicals, all the big majors, but also cosmetically what it will take. And then we lend to them on the purchase price. So um, the borrower might have to bring 10, so there's two numbers that have to work together. They might have to bring 10 to 20% down on the purchase or more, depending on how the numbers work out. And then we're funding up to 100% of that construction. So essentially, they're borrowing against future equity in order to rehab the property. But remember, even with the purchase loan, the construction loan, there's still 30 to 40% cushion on what that true property value is. Okay. Part of that is what the borrower already brought as a down payment. The other part of it is, what's left to capture in the market. Okay. So there's that cushion there. And so when they go to do they put together the budget, and oftentimes our borrowers will start with the mechanicals because that tears up the yard and creates a lot of dust. So they'll go replace the water heater, the HVAC, maybe the flooring, and they'll also do the roof, like initially. Well, those we know that they're going to get some sort of part of that project done in the first 30 days. And if they're not taking a draw, meaning they're not showing us a receipt, hey, I did the roof and the roof costs 10K, right? They want to get the loan so they can replenish their money they have to go do the next phase of the project. If they're not showing us that receipt and putting in a draw, we're kind of getting like knocking on their door going, did you do the roof? Did your roofer bail on you? Like, why isn't the HVAC done? Right? Like all these things that could have been stacked up in the first week. So that is where we tend to, uncover like, most of the time it's just that they, a timeline extended, weather got in the way, or a relationship fell through. And so we're in contact with them. Now, our goal is not to take over the property or the project. Can we do it? Yes. Will we do it? Yeah. If we foreclose on the property, we're going to do that and we're going to capture that 30, 40% for ourselves. But our intent, we're a bank, we want to lend the money. We're a lender. So that's just one piece, kind of like, that we try to uh, stay just in better connection with our borrower.
Yeah, and I think what that illustrates through the construction draw process is, in addition to kind of the regular servicing that goes on of just collecting the payments and everything, there is a these are business purpose loans that you're creating. So there's a business objective, and your investors are buying into short-term duration loans. So that means that activity needs to happen pretty fairly quickly in terms of executing on that business strategy, and the draw process gives you just a very natural way to monitor what's going on to make sure that the project stays on track, and that as you said, that sometimes delays happen, but if the project's supposed to be over in 12 months, then you better be seeing activity fairly soon. And if not, there could be a problem. Are there any examples where, there wasn't a draw and it wasn't just sort of like weather related or something like that? And can you talk about like what action was taken?
hmm Yeah, we last year, and we also have some other mechanisms in place. Like we cap our borrowers at about 1 million to 1.5 million out with us. So if they're a new borrower with us, they can only get a max of 2 loans
Hmm.
until they reposition those 2 loans, and then they've proved to us that they can handle more loans. Once they prove to us they can handle more loans, then they're capped at 1 million to 1.1 to 1.5 total money out with us. Now, at any point in time, we have about 130 million out in play. So that's like not even 1% of the portfolio, like with any one borrower. So that's huge. Um, that's huge protection to our limited partner investors. So, as far as an example, we had a gentleman who, you know, long story short, he was a proven borrower with us. He had multiple loans out. He was right at that $1 million cap, and he had a heart attack.
Yikes.
Yeah. And he didn't die. So yay,
Yeah,
right? But at the same time, he needed to focus on his own health. It was a non-judicial state. And so we stayed in conversations with him. It took a couple weeks. And then finally he was just like, you know what? Here are the keys. I'm going to get myself healthy and then I'm going to start again. Right? Like, so he handed the keys over. Now, that's not fun either as a lender to get multiple keys to a property, right? Because remember, we don't want the property back. We want to be the bank, right? Like, we want our babies, investment babies making babies. But it speaks to the depth of our team because, our team went into action. One, we shopped the portfolio internally to current borrowers we were working with and say, hey, does anybody want to any or all of these properties? We sold some off that way. We took a couple REO ones that we were just like, is it worth it to us to actually complete the rehab ourselves? It's like if you're going to complete a rehab, like, a flipper might not pick up the paintbrush unless they're going to make 40K or 50K. If they're only going to make 10K, they're just going to sell it, right? So we sold off some of those in an REO process, and then we also uh, there was like three or four that we kept, and we are just like we can make some serious money here, and so our team was able to complete those internally,
that's
so
awesome.
and get
I
them
mean, that's
sold.
not, that's, I'm sorry that happened, and I'm sorry. I hope the guy's health is better, but great
Mhm.
example, and especially because it demonstrates multiple ways that you were able to solve the portfolio. So great
Yeah.
stuff. I can talk to you about this stuff all day, but I will not. I didn't realize it was already past 1. So I'll let you close it out with any final thoughts, and we can end this thing.
Yeah. If you're interested, in how a real estate debt, fund investment would fit into your portfolio, reach out to me at passiveinvestingwithwhitney.com. You just fill a quick form out there. You get access to my calendar and we can hop on a phone call.
Beautiful. Thanks very much, Whitney. This was great. Really appreciate all of the knowledge that you shared. Hit on a lot of great points. Everyone who is in the audience, thanks for joining. Really appreciate that you were here, spending some time with us during your afternoon, your lunch hour, your morning, wherever you are located. Be sure to catch us on next Thursday's webinar. Otherwise, have a great day, everyone. Thank you.
Thanks. Take care.